Hi, everybody. This is Dale Branda with Stewart Advisors. Welcome to another in our series of webinars on topics of interest to clients and our other friends. Today, we're going to be talking about socially responsible investing and how you can do well and do good. As usual, I'm joined by Tim Obendorf, also from Stewart Advisor, to help present. Tim is a veteran financial planner, and he's worked with a lot of clients on a range of financial planning issues. Stewart Advisors is a financial planning and investment firm, and our mission is to help individuals, families, and businesses realize their goals by making really good financial decisions. As you can see from the slide, we provide a range of services, and we want to help clients develop a consistent, holistic financial plan. We think it's critical to start with people's values and then develop a deep understanding of their goals and financial situation, and then integrate values into the financial plan. One of the reasons that we're excited about the topic of socially responsible investing is that it's an area where people can really align their values with their investment. So let's take a look at what we'd like to cover in the next 30 minutes or so. First, we want to review some of the terminology related to socially responsible investing. There are a lot of different descriptors out there, and it's important to understand what it is we mean when we say socially responsible investing. We'll also spend a short time looking at the history of socially responsible investing, which is actually longer and more robust than you might think. And we'll review some of the data and tools available to help you design a values-driven portfolio. Finally, we'll overview our approach, and we'll give you an idea of how a values-driven portfolio comes together using a real-life example. So at this point, let me turn it over to Tim and we'll get started.
Thanks, Dale. Question I have for you is, what do you think of when you hear the term socially responsible investing? There's a lot of terms thrown around that relate to socially responsible investing, or SRI for short. But at the end of the day, SRI is about integrating your values with the way that you invest. Here are some of the ways that people think about SRI. So on the left-hand side, you can see some categories that are from the Global Sustainable Investing Alliance. I'm just going to run through these quickly. So there's negative or exclusionary screening. So that's where you don't invest in certain companies that are in certain industries or have certain practices. There's positive best-in-class screening. So you look for companies that are doing really well in areas like their environmental practices or gender pay equity. Norms-based screening is just looking for companies that meet certain minimum business standards. There's standards put out by the OECD or the UN or other organizations, and so it's just looking for companies that meet those minimum standards. ESG integration. ESG stands for environmental, social, and governance, and so we're looking at ways to invest in companies that have good practices in those three areas. Then there's sustainability themed investing. This might be something like investing in clean energy or investing in companies that have certain practices with employees. There's impact investing, which is kind of a combination of investing, but also looking at specific quantifiable impacts that can happen, and it may involve even giving up some potential return to accomplish those goals. Community investing, which is like impact investing, but it's more geographically focused. It might be looking at a specific neighborhood in a city and investing in real estate or investing in certain business opportunities in that geographic area. Then there's corporate engagement and shareholder action. So this is where you invest in companies, but you're active in promoting certain shareholder resolutions or engaging with management to make certain changes. The terms on the right are just other terms that are thrown around in this area. So there's ethical investing, green investing, which is like it sounds, it's environmentally focused, mission-related investing, responsible investing, socially responsible investing, and values-based investing. At the end of the day, the SRI goals are subjective. They depend on the individual investor, but it's really about connecting your values with the way that you invest. While you may think SRI is a new concept, the idea actually goes back several hundred years. In the 18th century, several religious organizations that were opposed to slavery encouraged people to do business or not do business with folks that promoted slavery or alcohol consumption. John Wesley was actually a big proponent of using your money and your investments in a way that would do good. In 1898, the Quakers' Friends Fiduciary Fund was founded, and that fund continues to manage its assets following SRI guidelines today. The first public offering of a screened investment fund was in 1928. It was the Pioneer Fund. It was established by a group of clergy in the Boston area, and it used exclusionary screening to make sure that its investments were in line with their ethical goals. More recently, student activists opposing the Vietnam War in the 1960s pressured their university endowments to divest of military contractors. And kind of around the same time, in 1971 was the launch of the PAX Fund, which was primarily or initially set up to screen out companies that were engaged in producing military equipment and supplies that were supporting the Vietnam War. Then in the 1980s, we had SRI proponents focused on screening out investments in South Africa. And the goal there was to pressure the South African government to end apartheid. And in 1993, when the de Klerk administration took steps to end apartheid, there was about $625 billion that was invested in funds that were being screened to exclude investment in South Africa. In 2015, the United Nations established the Sustainable Development Goals, and 193 countries signed on to the initiative. And that laid out 17 areas for responsible development, which include no poverty, quality education, clean water, and gender equality. And many investors are using these goals to guide their SRI initiatives today. SRI has recently gained traction, especially in the last 10 years. And here you can see the growth in sustainable investing by different region from 2016 to 2018. In the US, there's now nearly 12 trillion invested in sustainable focused investment initiatives, with most of that in the US following ESG guidelines. And we'll talk more about what ESG means in a few minutes. The European market is still the largest market for socially responsible investing. It's a more mature market. It's growing slower, but it's still the largest market. Most of the European investment is focused on norms-based screening or exclusionary investment. The pie chart on the bottom shows you a breakdown by asset class. So you can see that both stock and bond markets are significant areas where sustainable investing is happening. Public equity, which is the stock market, is just over half of the sustainable investing assets. And then fixed income or bonds is about 36%. But there's also some additional asset classes such as real estate or private equity and venture capital, where there's opportunities to invest in a way that aligns with your values. As sustainable investing has grown, so has the sophistication and the data available to make good investment choices. There are now standardized data sets, with the most robust being driven by the Sustainable Accounting Standards Board. And that data is being made available through tools like Bloomberg and Reuters. In fact, Reuters now provides over 400 ESG data points on 3,000 or more companies. And the availability of the data has now allowed sophisticated investors to move from merely screening out bad actors to finding ESG or sustainable levers that actually drive outperformance. And I was recently at a presentation where a large pension fund had partnered with BlackRock Investments to use machine learning and artificial intelligence to find ESG drivers of performance. And one of the things that they were looking at is companies that had actually improved their carbon footprint. So it wasn't just that they had minimal carbon footprint, but that they were actually improving their carbon footprint, had outperformed other companies in their database. And so they were using this to actually find ways to outperform the market. Other investors are also using ESG factors as part of their fiduciary due diligence. So for instance, they're looking at companies and industries that may be financially at risk from global warming, and they're managing the exposure that they have in their investment portfolio accordingly. I'm going to turn it back to Dale to talk about what the ESG categories and some of the other data points look like in the market.
So we've thrown around the idea of ESG a bit, and I wanted to dig into that a little bit, and so we have a better understanding of what that means. And as Tim mentioned, a big part of the socially responsible investment community looks at ESG, environmental, social, and governance, as a kind of rubric for analyzing and talking about sustainable or socially responsible investing. In some ways, this breakdown allows investors to go beyond just excluding certain specific bad things, focusing on one factor, and allows them to consider how good companies and funds are overall in what they're doing. So the pillars of ESG themselves are pretty self-explanatory. So you can see environmental looks hard at the company's carbon emissions and greenhouse gas production, as well as how they impact and manage other ecological risks like water scarcity or waste management. The social pillar considers things like how companies treat their workers and whether they promote diversity, how they include women. And where applicable, this pillar would also include a company's treatment of animals. The final pillar, governance, is one we might not think about as much, but how a company compensates its executives and whether its board is diverse and truly independent, or how a company avoids corruption are really big ethical issues that investors often care deeply about. So with that said, I want to take a quick look at how we approach building a sustainable or values-based portfolio. And in this area, I think Tim alluded to this earlier, the emergence and the continued development of data to help evaluate ESG has become a big game changer. And there are now a number of sources to help evaluate individual companies and funds and other investment vehicles on ESG criteria, in addition to just measuring their traditional metrics like risk and return. The primary data source that we use is Morningstar, which is one of the leading financial information vendors for investors. In 2016, Morningstar began offering a specific ESG rating on a whole array of funds that they cover around the world. And since then, the number of funds covered has continued to grow, and in 2018, Morningstar updated their methodology to be even more comprehensive. They also added a separate and distinct rating specifically for carbon risk and impact. Now, the methodology Morningstar uses for doing all this is really complicated and rigorous, but in short, they and their partner, Sustainalytics, produce a detailed analysis of almost 5,000 companies around the world, and they assign each one an ESG score. For a fund, the scores are combined into an overall ESG score that can be compared against other funds and companies across all investment sectors. So just as an aside, it's interesting to note that the ESG score that they give considers not only how a company does on the long haul, but individual controversies that also might affect performance. So, for example, if an oil company might have a generally good ESG score compared to its peers, but if it's got a bunch of major oil spills going on right now that are causing huge environmental damage, its ESG score would be adjusted down based on the specific event. Or in another example, a company that's generally a pretty good ESG score company, but they're currently embroiled in a number of complaints that point to a culture of harassment, they might see a deduction as well. So once the ESG score has been determined, Morningstar compares that score to others in the same investment sector and assigns a rating of 1 to 5, which is illustrated on the slide. And for those of us who like visuals, Morningstar kindly presents their final ESG rating as globes. So if you pick a 5-globe investment, you know that that investment sits in the highest 10% of its category compared to its peers. So now that you have the data, the next step is to combine it with other information and create a sound portfolio that's right for you. I should say that the process that I'm about to describe isn't entirely proprietary, but there are tools available to those who aren't financial professionals. But a lot of the tools that we have access to make it easier to do the analysis for sure. Now, when you do this, it's easy to get lost in the ESG side of the investment, but you want to make sure that the portfolio also accomplishes your other goals, like providing a suitable return and providing a manageable level of risk. So with that in mind, we always begin with a thorough discussion of all the client's goals, including their financial goals and their investment values, in addition to their SRI goals. As we think about SRI goals, it's important for individuals to prioritize them along with their other concerns, because teasing out what works for you can be more complicated than it seems. So for example, if you decide to avoid oil companies and pursue low carbon investments, how do you feel about nuclear? So depending on your viewpoint, nuclear could be the solution, or it could be a problem 10 times worse than carbon. So hopefully our case study that we'll get into in a minute is going to illustrate why it's important to rank order your priorities, have a clear understanding of what's really important to you. So once all this values clarification and ranking is accomplished, you can begin to use the data and find investments that have the right scores and focus on the right areas that align with your values. At this point, you'll want to consider investments that have a specific ESG mandate. In other words, they were created specifically to do certain ESG things, or investments that really don't have a mandate, but they just happen to be doing really well in the ESG areas that matter to you. As Tim mentioned, a large part of the ESG effort right now is focused on equities. However, fixed income and other products with a focus on ESG are appearing on the market in greater and greater numbers. So once you've identified all your options, you need to make sure that the portfolio contains enough other investments, like bonds and real estate, commodities, and so on, so that it's well diversified. Many of these other investments that you'll be adding to the portfolio are fairly value neutral with respect to ESG. And you need to get a well-diversified, well-constructed portfolio to meet your other non-SRI investment objectives. So now that we've talked about the general process for integrating SRI into your investment decisions, we want to take a look at a case study that's based on actual investor experience.
So I'm going to walk through a real life example. This was a client that we began working with a few years back. He was in his mid-30s, very interested in integrating socially responsible investing into the criteria in building his portfolio. And he asked us to find funds to build out his portfolio that adhered to the values that he held. And we began to talk through, what the ESG goals were, and he had quite a few. The goals included minimal carbon emissions, no animal testing, no exposure to companies that employed child labor. An interesting one was that he wanted to exclude companies that supported the NFL. This was around the time period that there was a lot of controversy about racial disparity in the NFL. We looked at excluding companies that had ethical breaches or that manufactured in emerging economies. And so we started sifting through all these funds. And the challenge was we ended with almost no funds that met the criteria. And then when we did, we found a couple funds that met the criteria, but the client started looking at the companies that were in those funds and identified a handful of companies in those funds that he didn't want to have exposure to. And so at the end of the day, no funds met all of his criteria. And by only having two funds that met, most of his criteria, he would have been left with a very undiversified portfolio. So we went back to the drawing board and had a conversation with the client about what were his most important social or environmental, socially responsible investing goals. And the key goal that we boiled it down to was that he was very concerned about investing in funds that had a positive environmental mandate. And in particular, He was looking at funds that invested in companies that had good carbon emissions policies. And so we used the Morningstar ratings guide, used the GLOBE system of the Morningstar funds, and we looked at how we could build a portfolio that was diversified, met his financial goals, but also reduced the contribution of carbon emissions into the economy. One of the interesting things that we found was a set of funds that didn't totally exclude all companies that were involved in the oil industry or manufacturing industry that emitted carbon. But what the fund did was it looked for for companies that were very good at positive environmental change. So they were the most sustainable companies, and it overweighted those types of companies in the fund. And then it excluded or minimized companies that were operating with the least sustainable practices. So it meant we might still be invested in the airline industry that uses a lot of fossil fuels, but we might be investing in a particular company in the airline industry that has high efficiency practices around what type of aircraft they use and the routing that they use. And so overall, this was an ability to have a diversified portfolio that had exposure to all the industries that we wanted to have exposure to, but enhanced the goal of minimizing carbon emissions by picking good companies and excluding some of the worst performers in that area. We focused mainly on the equity or stock side of the portfolio, and we were able to look at both domestic, so US company stocks, as well as international stocks. And using this methodology, we were able to get about 50% of his portfolio allocated into funds that had very positive carbon emissions ratings. We also had exposure to other asset classes besides the equity markets, and we're able to get, by doing that, have a diversified portfolio with a risk profile that was appropriate and very similar to other portfolios that we've built that don't have SRI mandates. So at the end of the day, we were able to accomplish his financial goals, but also have an impact and integrate his most important SRI goal of reducing carbon emissions. So the bottom line is that, yes, you can really make a difference. You can align your money with your values, and you can do this in a way that that is very sophisticated and doesn't give up a lot of investment return and doesn't take on a lot of additional investment risk. And because the market's growing and because clients and investors are choosing to integrate socially responsible investing into their portfolios, it's creating demand. And so more and more fund companies are competing to get investors that want to have socially responsible investing integrated into their investment process. The other thing that's happening is that as more and more funds and more investors are focused on these goals, corporate executives are listening to the investment community, and they're integrating good practices into their businesses. So now more and more companies are reporting using the sustainable reporting initiatives, the Sustainable Accounting Standards Board's initiatives. And so there's more data out there. Companies are making decisions based on the goals that investors are telling them that they want them to make those decisions based on. And companies are changing their practices. Also, as this whole industry of socially responsible investing is maturing, there's becoming more information and more ability to actually use SRA data to drive outperformance. So yes, you can make a difference. You can do it in a way that doesn't negatively impact your investment returns. And the more people that choose to invest this way, the more impact it has on companies and fund companies that are investing in these companies. So with that, we'd like to open it up for some questions. I'll turn it back to Dale for Q&A.
Thanks. We do have a couple questions that have been submitted. And if you would like to submit a question now, please use the Q&A button to send them in. Also, this would be a good time to remind you that if you have any questions about this material that you want to talk to us about directly, feel free to reach out to any of us at Stewart Advisors. We'd also be happy to help you evaluate your portfolio regarding ESG or other socially responsible objectives that you might have. Okay, so our first question is a pretty straightforward one. Does socially responsible investing have a negative impact on the returns that I'll receive?
Yeah, that's an interesting question. And modern portfolio theory says that if you exclude certain companies from the potential universe that you invest in, that you reduce the opportunity set to earn a good return. But what's been interesting is as this type of practice has developed, the market for socially responsible investing has changed from just excluding companies to actually promoting companies to be in portfolios that have good, both environmental, social, and governance practices. And one thing that investors are finding is that good practices in, whether it's governance or diversity or the way that they handle their environmental concerns tends to drive good business practices everywhere in the business. In fact, there was a recent study that was published in the Journal of Financial Planning. It was in the May issue that looked at funds that had high Morningstar Globe ratings and compared them to funds that had low Morningstar Globe ratings, and found that there was basically no material difference in the returns and the risk of those funds. So we're no longer giving up return to be able to invest and make our investments aligned with our values, I guess, is the bottom line.
Okay. We have a couple of questions along the same line, which is, how does a non-investment professional choose and use SRI criteria? So what data sources are available to the non-professional to do this kind of screening?
Yeah, so the data is becoming more and more available, but a lot of it is still only available through subscription services. So like Bloomberg and Reuters and Sustainalytics and Morningstar are all services that professional investors subscribe to be able to get this data. Companies are publishing and releasing their reports on that are in compliance with the Sustainable Accounting Standards Board. So if you do some digging, you may be able to find ESG reporting on an individual company basis. It's also making its way into company annual reports. The other thing that you can do is when you're investing in mutual funds or exchange traded funds, you can look for funds that have a mandate or explicitly say that they're investing with a certain socially responsible objective. And the same study that looked at whether ESG outperforms or underperforms other investments also looked at funds that said that they were socially responsible and looked at whether they actually did perform in a manner that was consistent with their socially responsible goals. And I found that basically about 80% of the funds that say they're socially responsible actually do operate in a way that's meaningfully different than just general funds out there. So just looking at funds that say that they're investing in a socially responsible way will get you there about 80% of the time. You know, if you're interested in going further, we at Steward would be happy to review your current portfolio and give you a sense based on the Morningstar data that we have of whether your portfolio is in alignment with ESG goals and criteria. And we can give you some ideas of how to improve that and build a portfolio that incorporates the goals that you want.
We're nearing the end of our allotted time, but I would ask maybe one additional question that's been submitted. And the question is, how do I pursue socially responsible investing when most of my portfolio is in a 401k?
Yeah, that presents a little bit of a challenge. One of the interesting things is that pension funds were kind of early entrants into the whole SRI, sustainable investing practices. So the pension side of people's retirement plans, if you still do have a pension, probably has some SRI objectives included in it. Now, as more and more retirement funds, retirement plans that companies have moved into defined contribution or 401k plans, it creates a little bit more of a challenge because the company sponsoring your 401k plan chooses the lineup of funds. So you could look at the lineup of funds that's available to you and use a resource like Morningstar to see if those funds score well on ESG or sustainable investing goals. But at the end of the day, if they don't, you're kind of beholden to the plan administrator to make changes in those funds to bring it more in alignment with ESG goals. And so that requires going back to your company and saying, hey, I'm really interested in investing in a way that's in alignment with my values. Can we add some funds to the plan that includes those goals? So it's becoming more and more prevalent, and the more folks that ask for it, the more availability there will be. But if you don't have it in your plan, it makes it a little bit complicated to be able to do.
All right, well, that is about it for our time. We appreciate everyone who joined us, and please be on the lookout for our next webinar offering. Thanks.